your part-time controller. Dedicated to helping nonprofit organizations with all of their accounting needs. More information is available at yourparttimecontroller.com.
Good morning. Thank you all for coming out here today, especially in this lovely weather we're having. I really appreciate that. My name is Patty Withington, and I'm with Your Part-Time Controller. I would bow wow, and I know some of you know me as the big red dog. I won't do anything today, promise. But anyway, I do want to introduce Patrick Callahan. He is with Tech Impact, and he's actually one of our clients, and he is going to introduce Eric Frank for us today. Again, thank you for coming out today in this bleak weather, and please move down, get yourself seated, and get comfortable because great presentation, it's on its way.
Thanks, Patricia. So good morning, everyone, and thank you for being here. I was really excited to see your part-time controller and Eric put together this series of talks. I think it's just so important that we get this kind of information. And speaking of information, I spent a little time this morning. First, when I came in, I talked to Eric. I said, "You got to let me introduce you. I'm really excited to be here." And reluctantly, he agreed. So I talked to some of his staff. And I said, "Tell me something funny about Eric." And really nothing came out. They were very cautious, and the only thing they could say is that he's very meticulous. And I know this firsthand, and I'll tell you why. About some time ago, Eric was in our office, and he sat down with me, and he said, "Tell me about some problems that you're having, what you're trying to solve from a financial side." I said, "Well, I'm really trying to get into this cost accounting. I want to understand the different areas of our business." And he said, "I've got it. I'm going to take your data, and I'm going to develop this new spreadsheet, super spreadsheet, and then I'm going to come back to you, and I'm going to show this to you, and it's going to change your life." And I said, "That's fantastic. This is exactly what I need." And I really admire Eric and the business that he and Jen have built, and all the folks at Your Part-Time Controller. We've been a client for 7 years, and I can tell you, over the last 5 years or so, I don't recall having a single management issue in our audits, and I know it's not because of me. It's clearly because we have excellent bookkeeping and excellent accounting and great controls in place in our business, and I'm just so thankful of that because it's one less thing that I have to worry about in our business. So with that, I'd like to have Eric come up. Not only is he an accomplished businessman, but he's also on the faculty of University of Pennsylvania. So we're very, very fortunate to have this kind of talent in our city and someone here willing to share this morning with us, and a nice breakfast and a great talk. So, Eric?
Never going to forget that. Thank you, Patrick. My kids, by the way, will insist that I've never said anything funny in the last 20 years, so you're right on point with that. Patrick is the Executive Director of Tech Impact, formerly NPower. If you're at a nonprofit organization and you need some help with your IT, Patrick is the man to call. So please remember his name. Before we get started, I just want to introduce a few people who are providing various services to the nonprofit community. In no particular order, we've got two attorneys here. Morgan Cheshire. Morgan, where are you? Morgan's in the back. And Don Kramer with Montgomery McCracken, right here in the front. I recommend both of them very much. We have a few auditors who are here. Let's see, I saw Mike Sutter from Sheckman, Marks & DeVore. There's Mike. Tom Sulpizio is in the back, also from Sheckman. Ed Suarez with Renzi, Bernardi, Suarez and Company. Ed, where are you? Everyone's in the back. I have, is there someone here from Elko and Associates? Okay, we've got two people from Elko and Associates. So that must be Rachel and Mike White. So welcome, folks, to be here. We've got some consultants, Nancy Moses, who is a well-known consultant. There's Nancy sitting over there. And also we have Wendy Epstein, who also does consulting. Wendy, where's Wendy? Wendy's right in front. So one of the, and also among the auditors, Eric Strauss with Witham, Smith & Brown. Eric. And I think that's it. I also want to mention Andy Mers with the Mers Group, who does marketing and public relations. Andy, you're here somewhere. There's Andy. And I should also mention Phil Arco. Phil helps us. Here's Phil right here. I'm a little hesitant to recommend Phil because we love him so much. We're afraid that if he ever gets too busy, he won't have time to help us. So if you do call Phil, just use him sparingly for your marketing and public relations. All right. So thank you all. Matt Hugg is also here. Matt is on the faculty with me at Fels Institute of Government and also does writing for nonprofits. So sorry, Matt, I almost forgot about you there. All right, charity watchdogs are watching you. This is a quote that was in the Philadelphia Inquirer just recently, September 29th, just about a week and a half ago. The time has passed when donors invest or make contributions because it's the right thing to do. They want to see their investments yield results. That was said by, or quoted by Rebecca Reimel of the Pew Charitable Trust. And I underline, they want to see their investments yield results. That's the big question facing us all in the nonprofit world. How do you measure results? How do you know how effective or how efficient your nonprofit organization really is? And that's where the charity watchdogs are going to come in, and we're going to talk about what they do and what's wrong with what they do. So we all want results. You know, as I say in the slide, who's not in favor of having a higher performing, more effective nonprofits? But how do we measure them? That is the question. All right, so while we're all grappling with this issue of how do we determine how effective our organization is, a group of organizations have sprung up over the last 10 or more years. They generally go by the name of charity watchdogs, and in fact, at least one of them actually refers to themselves on their website as a charity watchdog. They are evaluating you now, or they might be evaluating you at some point in the future. And donors are looking. Now, I don't know how many donors are looking and how many of those donors that are looking are having their philanthropic decisions being impacted by what they see. But certainly some donors are looking. And that's sufficient for me if, and I, by the way, I also serve on a board of a nonprofit organization, and I've served on other boards. That's sufficient for me and sufficient for our clients that we should be taking some prudent steps in order to present ourselves in the best possible light. And that's what we're here to talk about today. So what about your organization? Are you being rated? Do you even know if you're being rated? Are the ratings of you fair? And I think by the time we're done at 10 o'clock, most of you will, I hope, if I'm effective with what I have to say this morning, most of you will feel that if you are being rated, that there might be things in the rating that are unfair. If not, what can you do about it? All right, the stakes are high. Your ratings could impact the donors who are giving to your organization. All right, so here's what we're going to talk about today. We're going to talk about how did this situation develop. We'll take a look at a brief history of this movement towards outcomes. We'll talk about the charity watchdogs, and we'll talk about who they are. Then we're going to move right into looking at 2 or 3 of the primary charity watchdogs to discuss what it is that they're actually looking at. What are they looking at, and how are they measuring you? From there, we're going to have a digression to talk about something called the overhead myth letter. and the limits of overhead ratios. And then lastly, and most importantly, we're going to cover what you can do to put your organization's best foot forward. So a brief history. As we talk about this, the history that we're going to cover is really in 5 parts. We're going to talk about the growth of outcomes. We'll talk about the IRS 990 and the infamous 3 columns. We'll talk about accounting rules. And when we talk about accounting rules, don't worry, we'll talk about them very briefly. And other than this one time, I'm not going to say debit and credit again for the rest of this morning. And I'm a CPA, by the way. Then from there, we're going to talk about GuideStar, and then we're going to go back to the charity watchdogs. Okay. So where did this come from, the growth of outcomes? I don't know how many of you are familiar with the Harvard social analyst Lizbeth Shore, but she wrote a book in 1997 called Common Purpose. This is the first book that I read that talked about outcomes and similar issues in the social services environment. And she talks, and if you haven't read that book, get it and read chapter 4. That is required reading for everyone in the nonprofit world if you have any concern whatsoever about the field and the world of outcomes. But here's what she says in her book in 1997. The nation's ability to know whether programs, policies, and tax dollars are achieving their intended purpose is in the midst of a revolution. The new attention to results signals a profound shift. Since the mid-1980s, accountability for results has emerged. So already in 1997, we have a prominent author in a book talking about being in the midst of a revolution and talks about accountability for results already underway in the mid-1980s. So this whole issue of outcomes is certainly nothing new. It's been with us for a long time. Foundations, governments, and donors are beginning to seek better information about outcomes. And as they do, nonprofits are finding more and more pressure to measure their outcomes and to report these to funders. Now, I would maintain that whether funders are requesting this of you or not, that this is a positive thing. Well, though measuring outcomes oftentimes is difficult, and in some cases I would maintain virtually impossible. Nevertheless, I don't think that really excuses an organization from at least trying to ascertain the effectiveness of their programs. But I digress here. So foundations, governments, and other donors are increasingly looking for this information. Locally here, the United Way was one of the first organizations in Philadelphia and also nationally to start to really talk about outcomes in a big way. All right, so this brings us to the IRS Form 990 and what I'm referring to as the infamous 3 columns. Now, you're probably looking at this saying, Eric, there's 4 columns. Can you count? But one is the total column, so I'm not considering that as among the 3 columns. But if we zero in on those 3 columns, we're looking at program, service, management in general, and fundraising expense. Now, how many people by show of hands are familiar with your 990? So everyone. Tom, I didn't see you raise your hand. Tom Sulpizio with Checkman Marks, are you familiar with the 990? So now I had lunch the other day with Don Kramer, and I asked Don if he knew when the IRS first started asking for this information. Neither one of us knew. I did a little bit of research and tried Googling it. The earliest that I could find was I found a 1990 990, and already these 3 columns were on there. And in fact, it actually is printed right on the form where it says, describe what was achieved in carrying out your exempt purposes. Fully describe the services provided, the number of persons benefited, or other relevant information for each program title. And they talk specifically, and this is the phrase that was used then and is still used today, they're talking about program service accomplishments. I suspect that they first started doing this in 1976 because already in 1990 they were saying the last major revision of the 990 was in 76. But regardless of when they started, the IRS has been looking for this information for a long time. So we have the trend towards outcomes, then the IRS comes along and the IRS starts requesting this information on the 990. All right, well, along comes the FASB, the Financial Accounting Standards Board, that issued a rule called FASB 117. This rule came out in 1993. That happens to be the year that your part-time controller started, just by coincidence. So when I started your part-time controller, and I didn't know anything 20 years ago about nonprofit accounting, the good news is nobody else knew anything about nonprofit accounting because the rules had just come out. And along with 116 and 117, these two rules are the bane of everyone's existence here. That's another topic which we don't have time to go into, but I write a blog where I write about this extensively, so feel free to take a look. But starting in 1993, in your audits, you've got accounting rules that require essentially the identical information to be reported. And in your audit, it's referred to as program services and then supporting activities. And supporting activities are defined as fundraising, management in general, and for those organizations that have memberships, there's actually a membership category. But the goal was a worthy goal. The goal was to try to measure and assess an organization's service efforts. So that's the phrase used in FASB 117, service efforts, as opposed to the 990, which is talking about program service accomplishments, but basically the same thing. All right, so now you've got everyone's talking about outcomes and the IRS and now accounting rules. And then the next big event was in 1994, GuideStar comes along. And in July 96, they published their first report. And later in 1996, GuideStar launches their website. So now, for the first time, 990 information is readily available. Anyone could log on, anybody can access this information, and I would be willing to bet everybody here has been on GuideStar, so we don't have to really dwell on that. If you haven't, take a look at it. So information is now available, and now, once information is available, there's an attempt to try to do something useful with the information. And as I go through this, I'm going to be speaking with some skepticism about what some of the charity watchdogs are doing. But make no mistake, as an accountant, I believe in the value of financial analysis. And I believe that there's such a thing as good financial analysis that could result in positive information, which could hopefully impact what your organization is doing. But on the other hand, bad analysis can have just the opposite impact. So Charity Navigator now comes along in 2001, and today Charity Navigator, according to their website, rates almost 7,000 organizations. Now, to put that into some context, there's about 1.5 million organizations, according to the IRS, that are specifically 501c3 organizations. So if Charity Navigator is rating 7,000, it's certainly a small number compared to the total that are out there. But it's their goal to do more. And as we see that there are others out there now who are also involved in doing ratings of one sort or another. Charity Navigator further says that their website had over 6.2 million visits in 2012, and here comes some of my skepticism here. They say on their website that approximately $10 billion of charitable donations each year are basically impacted by the information on their website. I like the part where they say approximately $10 billion is impacted. I don't know how they measure that, but that's what they claim. But whatever the number is, certainly some number is being impacted. Charity Navigator, interestingly, is not that large an organization. According to their audit last year, their budget's about $1.2 million, and they had 12 employees. So there's 12 people sitting in an office in Glen Rock, New Jersey. Glen Rock is significant to me because that's where I actually grew up. And those are the folks who are behind Charity Navigator. All right, but they're not the only ones. Since the Charity Navigator, and maybe in the case of BBBY's Giving Alliance, maybe even I think they preceded possibly Charity Navigator, but the Wise Giving Alliance rates about 1,200 national charities. And on their website, they don't say how many more, but they say over 10,000 are reported on by their local Better Business bureaus. GuideStar, which does not publish ratings per se, but as we get through this, GuideStar does something that sure looks like ratings, and we're going to have some actual examples of that. There's also a smaller organization called Charity Watch. They rate about 600 organizations. And then there are things called Great Nonprofits, GiveWell.org, American Institute of Philanthropy, and Philanthropedia, which was acquired by GuideStar. So, and this is by no means a complete list of the organizations out there that are accumulating information and reporting on what you all are doing. So here's where we are on our topics for today. So we've already talked about how the situation developed. We've already identified who some of the primary charity watchdogs are. All right, now let's take a look at what they are looking at. What are they calculating? How are they rating you? And how are they reporting this information? And Charity Navigator being the main player in this, we'll spend most of our time talking about them. All right, just curious, Charity Navigator, how many people have been on their website at some point? Just by show of hands. Okay, good. So it looks like most of us have been on their website. How did that happen? Somebody here from Charity Navigator in the room? So they say on their website that their tagline is your guide to intelligent giving. And I have no argument with attempting to provide useful information to the public. The question, of course, is how useful is the information? Who do they rate? They provide support to, or they look at organizations that provide public support of more than $500,000 and have more than $1 million of revenue. They also need 4 years, a minimum of 4 years of Form 990. Now we're going to start getting into some of the details here, but I promise not to say those 2 words that I said earlier that I wasn't going to say again. But you need to know the details. Because if you don't know the details, how do you know what they're looking at? If you don't know what they're looking at, how are you supposed to do something about it? So we're going to go into it at some level of detail, but we're not actually going to start crunching numbers during this presentation. All right, so right now they have what they call CN 2.0, CN for Charity Navigator 2.0. Originally when Charity Navigator started, they were only looking at financial metrics, and they have 7 of them. As they started to become criticized for that, and in 2008 when the so-called new 990 came out and had a lot more governance-related information, they came out with Charity Navigator 2.0. And they added accountability and transparency metrics. All right, so financial health, there are 7. Accountability and transparency, there are 17. The way they score you is that in each area you can get a maximum of 70 points. Your financial health metrics, there's 7. You can get a maximum of 10 points per metric. 10 times 7 is 70. Then they later, a few years later, introduced accountability and transparency. They wanted that to also equal 70. So how do you equal 70 now if you have 17 metrics? So each metric has a different number of points, which cumulatively can add up to 70 points. So let's take a look. What are these metrics? After they calculate your scores, I'm going to come back to this slide. Let's get this out of order here. So the use of 7, let's take a look at what these 7 financial efficiency metrics are. The first one's program expenses. All right, now this is something you're probably all familiar with. They take your total program costs off your 990, divide it by your total expenses. They come up with a percentage. They multiply that percentage times 10. So if your ratio is 80%, it's 0.8. They multiply it times 10. You get an 8 for metric number 1. And the next 2 are also familiar to everyone. Administrative expenses. So they take your admin expenses, they do the same thing, divide it by total expenses. But here, presumably a large number is bad, so they have a table where they take your percentage, and from the percentage, that works into a score. And I'm going to show you those tables in just a minute. Same thing with fundraising expenses. They'll take your total fundraising costs off the 990, divide it by total expenses, and then there's a table that you look up your score, and that gets converted to a number. Fundraising efficiency. They're taking a look at your total fundraising costs divided by the contributions that you brought in. And then the next 3, they're looked at over time. Primary revenue growth. How fast is your revenue growing? Presumably, if your revenue is growing, that's a good thing. Program expenses. They calculate that. And the working capital ratio. There's a calculation for working capital. All right, so there's these 7 calculations that are taken off your 990. And from that, a score from 0 to 70 is developed. But it gets a little bit more complicated. They start to make adjustments for various things. One is something that they call their indirect cost allocation adjustment. On your 990, there are different ways that you can allocate your costs. There's one particular method that they don't like. They don't like on a 990 if you show your allocations on a single line. What they will do, even though your financial reports were audited and your allocation methods were approved, even though your 990 may have been prepared by your auditor, they don't like to see your allocations done that way. Charity Navigator is going to back that out, and they're going to add those costs back into overhead. You can appeal that, and you have to contact them and explain to them how you did it if they do that to you. But we're going to talk more about that towards the end when we talk about the steps you can take to present yourself in the best possible light. All right, so they are taking your information on your 990, and they are adjusting it by adding costs back into overhead. There's another thing that they do to your 990, to your 990 information. How many of your organizations do periodic mailings where you send out a mailing, and in your mailing there might be some educational content or other information about what you're doing, and included in the mailing, maybe there's an envelope included or some other information encouraging people to donate to your organization. Has anybody done that? Okay, so most people have, and in the case of our clients, probably most of our clients at some point or another are going to send out a mailing like that. Well, there's all special accounting rules for that and how to take those costs and take a portion of those costs and allocate them to program expenses. The question is, how much of that is really fundraising? How much of that can justifiably be called a program expense? For those who are interested, the accounting rule that primarily addresses this is called SOP 98-2. I think I have this here in one of the slides. By the way, in terms of the slides, somebody asked me earlier, the slides will all be made available to you afterwards. We'll send out an email to everybody who's registered. Don, you didn't register, so you won't get the email. But everybody who registered will get an email, and we'll email all the slides out to you. But because I'm usually changing the slides right up until I go to sleep the night before a presentation, so we didn't leave enough time to print them out. But GuideStar, or Charity Navigator, will take this allocation, and they don't like this allocation. So again, even though it's been audited and so on, they're going to back out the program cost, and they're going to add it back into overhead. And there's one other thing that I forgot to mention here under program expenses. You'll see under metric 1, it's supposed to be there's a laser right here. It says adjusted down for deficits. If you've had a deficit in any of the 4 years that are covered in their review, they're actually going to take your program expenses and they're going to adjust it down. There's a calculation that they use where they take an average, and I won't go into the details of that calculation here, but there's a calculation where they're going to adjust that down. They didn't want to introduce a new metric because they wanted it to add up to 70. And if they introduced a new metric, it would have been the 8th metric, and then it wouldn't have added up. So instead what they did is they're arbitrarily adjusting one of your other metrics down. Okay, so the point to come away with this is that they're actually taking things from your 990 and they're changing it in order to come up with their ratings. All right, let's take a look at these tables because it's a very interesting phenomenon developing. Now, I gave this presentation last week and the screen was lower, so I was able to point. Even I can't reach all the way up there, so let's try this. So administrative expenses. Suppose your administrative expenses fall in the range of 0 to 15%. You take your total administrative expenses, divide it by total costs, and there's the 15% right there. If you fall in the range of 0 to 15%, there will give you the full 10 points. If your administrative expenses drop down, or just go a little bit over 15%, if you're in 15 to 20% range, they're going to give you a score of 7.5. All right, you lose 2.5 points. So at 15%, you get 10 points. If your ratio is 15.1%, you lose 2.5 points. You're losing 25% of that one score. The mouse is not working all that well. Let me try the laser pointer. Whoops. As you move across the top, 15 to 20% is 7.5. And again, you see this step function where it goes from 10 down to 7.5, down to 5, down to 2.5. If your administrative costs are over 30%, you'll get a 0. Coming down the left here are a number of different other calculations that they have for other organizations. Now, this is all on the Charity Navigator website. I did not reprint all of this. And this is all that would fit nicely on a slide. But they have come up with different ranges depending upon the nature of your organization. If you're a food bank, these are your percentages that they're looking at. If you're a fundraising organization, these are your percentages. If you're a community foundation, if you're a museum, and they've got a list of, I don't know how many different categories. Depending upon what category you fall in, your percentages will be different. Now, they say on their website that they're doing this in fairness to these organizations, trying to take into account the unique features of these organizations, but you can draw your own opinion as to whether you think that that's appropriate or not. But there's this step function, 10 points, and then you drop down to 7.5, and then you drop down, and so on. That's the table for how they compute your administrative costs. That's one of the 7 metrics. All right, here's a very similar table for fundraising efficiency. So this again is how much a charity spends to raise $1. If you spend 10 cents or less, you'll get the full 10 points. If you spend 11 cents to 20 cents, you're going to already start losing some points. Now, I don't know about you, but if I could find an investment where I could spend 11 cents and get back $1, and if I could keep doing that as much as I could, I would retire today, I would start my own foundation, and in a matter of time, I'd have a foundation bigger than the Gates Foundation. That is a pretty nice return on investment. Spend 11 cents, get back $1. However, you as a nonprofit, you're being penalized because of that. And again, we've got this step function. How many people have seen or are familiar with Dan Pelota? So fewer hands went up, maybe about half the hands. For those of you who aren't familiar with Dan Pelota, and if you only have 18 minutes to spare to get to know him, Google him and find his TED Talk. So earlier this year, he did a TED Talk. It's about 18 minutes long. And while I don't necessarily agree with everything that he has to say, he speaks very eloquently about the problems that we all face in the nonprofit sector with trying to deal with these ratios. If you have more than 18 minutes, buy his book called Uncharitable and read that book. We feel that in our firm that book's so important. That's actually required reading for our staff. There's several books when we hire someone that's required reading. That's one of the books. So highly recommend them. All right, so fundraising efficiency. We have a very similar situation here. And now, revenue growth. I'm not showing you all these, I'm just showing you a few. So revenue growth. Again, we have a variety of different organization types. Advocacy and civil rights organizations, animal rights, welfare and services, botanical gardens. They all have different ranges. So if you calculate, you go through their calculation for revenue growth, and you come up with a percentage. If the percentage is greater than 5%, you'll get the full 10 points. If the ratio is less than a negative 5%, you'll get 0. By the way, this is if you're an advocacy and civil rights organization. Anywhere in between, you'll get some point value between 0 and 10. So how did they come up with these numbers? I can't fully answer that question, but this is what they do. So that's primary revenue growth. Working capital ratio, similar situation. They're doing a calculation. You see where your percentage is. You look up your percentage, and that's how you determine your score. So those are the metrics for financial health. 7 metrics. You add up your score, and then they move to the second part. Remember we said that there's Charity Navigator 2.0. The second part now is accountability and transparency. There's 17 different metrics, and here they start you with 70, and then they start to deduct. Do you have an independent board of directors? If not, they'll deduct 15 points. Was there a material diversion of assets? If yes, depending upon one factor or another, they'll either deduct 7 or 15 points. Were your audited financial statements prepared by an independent accountant with an audit oversight committee? They'll deduct either 7 or 15 points. And on and on and on. Did you make a loan to a related party? If yes, they're going to deduct 4 points. Did you provide a copy of your Form 990 to the organization governing body in advance of filing? 4 points. If not, 4 points will be deducted. No conflict of interest policy? 4 points will be deducted. No whistleblower policy, deduction there. No records retention and destruction policy, 4 points deducted. CEO listed with salary not reported on the 990, they'll deduct points for that. Process for determining CEO compensation, if that's not adequately explained, deduction there. And if you've got board members listed and there's an issue with compensation, points will be deducted there as well. Okay, those all come, that first group all come from your 990. All right, and I purposely went through that quickly. The point is, and when you get the slides, you can look at these, and of course you don't have to wait for that. All this information is directly on Charity Navigator's website. But the point for this morning is to be aware of what they're doing and what they're looking at. Well, they're not done yet. There's 5 more metrics which are coming from your website. Right, now, how many of you list board members on your website? Okay, so just about everybody does. If you don't, they'll deduct 4 points. How many of you list senior staff on your websites? Okay, maybe about the same number of hands, maybe a few less. If you don't list your senior staff, they will deduct 4 points. All right, how many of you publish your audit on your website? All right, far fewer hands. Charity Navigator wants to see your audit published on your website. All right, so auditors in the room, tell your clients to take your audit report and stick it on the website. Otherwise, if Charity Navigator rates your organization, they're going to deduct 4 points. Now, there's no law anywhere that says you have to make your audit publicly available. There is a law that says your 990 has to be available, but not your audit. But they will deduct points if they don't see the audit. They also want to see that you publish your 990 on the website. All right, so even though your 990 is available on GuideStar, they want to see your 990 also available on your website. And quite frankly, I think with the IRS rules for the 990, I've been told, though I haven't actually read this myself in the instructions, that you have to make your 990 available to the public. Having it available just on GuideStar doesn't officially meet that requirement. But nevertheless, we find in our experience, a minority of organizations publish their 990 on their website, but do it. Privacy policy. They want to see a privacy policy with regard to how you're handling donor information. And you've got 2 different ways that they want to see it handled. They'll either deduct 3 or 4 points. All right, they get all this done, and I'm going to go back to that slide that I skipped earlier. They get all that done, and they give you some points. So you've got up to 70 for one, up to 70 to another, and they convert the points into stars. 4 stars is exceptional, exceeds industry standards, and outperforms most charities in its cause. And we're going to come back to this issue of outperforming. Does this really mean that you're outperforming another charity because of your ratios? But nevertheless, 3 stars means good, 2 stars means improvement, 1 star means poor. It's actually possible to get 0 stars. Performs far below industry standards. And they have something called a donor advisory, where if you've been in the news for something bad, and if it raises serious concerns about the charity, they won't give you any rating. Instead, they'll issue what they call a donor advisory. I took a look on their website. I think there's about 130 organizations right now that have a donor advisory out on them. So they come up with stars, and they rate you in both categories, and then they come up with a total rating. So how many people, are any of your organizations that you represent, are any of them rated by Charity Navigator? Okay, so just a couple of hands. And so I won't ask you, the folks who raised your hands, how many stars you got. Okay, I see 3 fingers. I see 4 fingers and 3 fingers. So as my parents said to me when I was a kid, if I ever came back with anything less than a perfect score on a test, they got mad at me. And so I would tell you that if you don't get 4 stars, you've got work to do. So don't assume that 3 stars, even though it says good, 3 stars is not good, because if your competitor down the street, another nonprofit doing similar work, has got 4 stars, and if there really are donors who are looking at this, they might be persuaded to pass you up and give to the organization that's got 4 stars. All right? So they convert your scores to a series of stars. And I should have mentioned that this is my favorite slide in this deck. When they take your 2 scores, they don't just take a simple average. They don't take the 2 scores, add them together, and divide by 2. All right, what they're doing is they're taking your financial score, subtracting it from 70, squaring it, taking your transparency score, subtracting it from 70, squaring it, adding the two together, divide by 2, take the square root, subtract it from 70. That's how they come up with your total numerical score. Now, for those who might be mathematically inclined, what this calculation actually does is it penalizes you the further away you are from 70. So if you're close to 70, this calculation doesn't move you too far off, but the further you move away from 70, the more your total score is being impacted. And then they take the overall score, and if you score 60 or above, you get 4 stars. 50 to 60, 3 stars. 40 to 52, 25 to 41. Less than a score of 25 are 0 stars. None of our clients, by the way, have 0 stars. Just want to let you know that. Not that I know of, anyway. They then plot this on a graph. Now, I like charts and graphs, so I actually like this graph. But here's what's going on here. I took an example. I think this was the best performing score organization I could find in Charity Navigator. Up at the top, they've got a perfect score for accountability and transparency. They've got a 70. And here's the accountability and transparency axis. 70 is right over here, so that's one part of the chart. For financial, they have almost a 70. They have a 69.93. Here's the axis for your financial score. There's a 70 up there. You plot both, and there's a dot right there, right up in the upper right corner. This zone here, if you're anywhere in this zone, you get 4 stars. Anywhere in this zone, you get 3 stars. Anywhere in this zone, 2, 1 star. And if you're in this zone, you get 0. All right, so this is an organization that, folks, this is too good to be true. I don't know offhand who the organization is, but their auditors should be questioned about the numbers in this report. All right, we won't go there because some of my best friends are auditors. I'm a former auditor, so I won't go too far down that road. Here's an organization that scored well with accountability and transparency. They've got a 70, so they're still right over here. But they fell down in their financial score. They only scored a 34. And notice, by the way, it's not just a 34. It's calculated to do 2 decimal places. It's 34.63. And that plots to right over here. So you go across. So in total, they fall in the 2-star range. I've got one more chart to show you. This is the opposite situation. Here's an organization that did relatively well with their financial score. They've got a 61, but they did very poorly with their accountability and transparency score. They got a 40. So they also got 2 stars, but they're over here. The slide before, they're over to here. This one, they're up here. Both of them get 2 stars. So when I looked at this, I was curious about this score of 40. What did they do wrong to get a 40 in accountability and transparency? What on earth could they possibly have done wrong? Well, here's what they did wrong. Well, they did report a material diversion of assets, so that's not good. So, okay, so they got downgraded because they had a material diversion of assets. But they did not have a donor privacy policy. So they got an X over there. They did not list board members. They didn't have audited financial statements on their website. They didn't have the 990 on their website. So they fell down in these 5 areas, and after deducting points, they ended up only with a score of 40. So I'll tell you that, not knowing anything about the organization, I spent about 10 minutes looking at this data, and after spending 10 minutes looking at this data, I was able to raise their score from 47 to 57, which had the result of increasing them from 2 stars to 3 stars. Well, how did we do that? Well, if they had a material diversion of assets, There's only so much you can do about that. Improve your internal controls for the following year, and hopefully that won't happen again. As we know with the work that we do, no matter how good your system of internal controls are, if you have the right combination of motivated people and possibly collusion, it could happen. But a donor privacy policy, why not enact a donor privacy policy? Have your board discuss it, come up with something that makes sense for your organization, pass it, and then you can answer yes to that question on the 990. Same thing with listing board members. List them. You're a public charity. Why not list them? We're supposed to be transparent. Audited financials, if you had an audit, include that on your website, and the Form 990, include that on your website. I can't imagine a good reason not to include that information on the website. So a few simple steps, this organization, if they take it for next year, even if nothing changes with their financial information, hopefully the material diversion of assets won't be a continuing problem in future years. But they could have raised their score from 2 stars to 3 stars. So that's an improvement. And who knows, if we actually went into that organization, maybe there's other things that we could have seen if we had an opportunity to dig into the data where, without violating any rules or without doing anything wrong, we could have showed them what things that they could have done to improve their score. By the way, you see this thing down here? If you're curious about this calculation, you don't actually have to set up this calculation in Excel and try to calculate your own scores. On the website, there's a page where you can put in your financial score, put in your accountability and transparency score, and it will compute for you your overall score. Okay, that's a quick synopsis of Charity Navigator. Before we leave Charity Navigator, they're talking now about introducing Charity Navigator 3.0. For 3.0, they are going to be trying to look at outcomes. But because outcomes are so difficult to measure, they haven't figured out how to measure it yet. So this is going to be very interesting because they've already committed to reporting on this, but they don't know how to report on it. So more of that to come. They're hoping that in the next 2 or 3 years, they're going to start having information about outcomes on the website. There's more information about it on their website, of course. Okay. BBB Wise Giving Alliance. Their mission is to help donors and charities, help donors find charities they can trust. We said earlier, they produce more than 1,200 reports nationally and more than 10,000 others locally and regionally. Does anybody know if your organization is being rated by the Wise Giving Alliance? Okay, so they're rating fewer organizations. So they have 20 standards. Now, in their case, because fewer people are impacted by them, we're going to spend less time, but I just want to give you a flavor for what they are. What they call governance, there's 5 standards. They have 2 standards in a category they call effectiveness, 7 standards in finances, 6 standards in fundraising and other information. For each of these, they have this little color-coded chart. Green check mark, which is what you want, that means that you meet standards. A yellow X means that you have not met the standards. An exclamation point says that you didn't disclose sufficient information for them to figure out whether you meet it or not. And ellipses means that they're reviewing you. Review is in progress. Question mark means they don't know what's going on. So they go through this, and they take a look at you in, here are your 5 governance standards, here are your 2 effectiveness, here are your 14 finances, and here's your fundraising information. And they give you one of these pictures in each category. In order to get an overall check mark, you have to have check marks in every category. Get something other than a check mark in any one category, and you lose the overall rating of a check mark. So this organization, whose name I hid, was not one of our clients. They got an X. Standards not met. And over here, they tell you it was number 18, standard 18. Come down to standard 18, they didn't list their donor privacy policy. Maybe they don't have one. But it's not there. They got 1X over here for donor privacy. Right? They did get a question mark here about accurate expense reporting. They weren't sure if their expenses were being accurately reported. But 1X mark threw off the entire rating for the organization. So if you're on the board of this organization, you're being rated. If I'm on the board of this organization, at the immediate next board meeting, I would start a discussion about, let's talk about a donor privacy policy. Okay, I'm only interested in just mentioning the finances. Here are the same folks that we've seen before. They're looking at program expenses, they're looking at fundraising expenses, they've got some other things, they're looking at accumulating funds, they're looking to see the audit report, detailed expense breakdown, accurate expense reporting, and they want to see a budget. So BBB Wise Giving Alliance goes beyond the 990. They actually, if you want to be rated by them, or if they're trying to rate you, they're going to ask you for additional information that you don't normally find on the 990. So now you're in a situation where you're supplying them with information. All right, so that's the Wise Giving Alliance. All right, let's talk about GuideStar. So, is there anybody in the room here from GuideStar? I should say that I love GuideStar. I love GuideStar. I'm not embarrassed to admit that. There's probably not a day that goes by that I'm not looking up some organization on GuideStar. Don and I have had this conversation a number of times where if an organization calls, while we have them on the phone, we're bringing up their 990s, I'm bringing up their 990, and while I'm talking to them on the phone, I've got all of their information there, and I could now talk to them intelligently about what their financial situation is there. GuideStar would maintain that they don't actually perform ratings. But perhaps you've noticed this. See these boxes? They've got these little chart with something called data depth. Now, it's possible that you need the premium account for GuideStar to actually see those boxes. I've been told that if you just have the regular free account that those boxes don't show up. But in any case, be aware that a lot of people are seeing those. And you can get somewhere between one to 4 boxes. So here's an organization with 1 box. Here's one with 2. Here's one with 3. Here's one with 4. All right, what do these boxes mean? Well, 1 box means that you're listed in the IRS's business master file. So congratulations, the IRS knows about you. And so by definition, you have to have at least 1 box. So you get 1 box just for being there. All right, 2 boxes. You have to have supplied a 990 to GuideStar. Or the IRS, I'm sorry, you don't provide 990 to the GuideStar. They get that information from the IRS. But here's an organization that apparently, because they only have 1 box, apparently they did not have a 990. And it says right here, Form 990 not available. And there's various reasons why that might be appropriate, which we won't get into right now. But that's 2 boxes. So most organizations are going to at least have 2 boxes, or 3 boxes. Self-reported information. So you're in the data file, you got your 990. Years ago when we used to teach about what to do with GuideStar, nobody realized, but today most people do realize that you have an opportunity to enter a lot of additional information about your organization on GuideStar. They want to see that you've taken advantage of that capability. So if you don't know what I'm talking about, go on to GuideStar, and there's a lot of opportunities to talk about your mission and your program service accomplishments and on and on. So take that opportunity to explain what your organization does. If you have that information there, they'll give you 3 boxes. To get 4 boxes, well, they want to see your IRS letter of determination. Well, send it to them. Let them have it. And they also want to see audited financial information posted on GuideStar. So now you've got an extra place where I recommend, if you want to get those 4 boxes, take your audit, post it on GuideStar. So they give you 1 to 4 boxes. So this is what we just talked about. Getting all 4 boxes is not difficult. Now, there's something new, comparatively new, that GuideStar has started doing actually a couple of years ago. They now accept and encourage other people to log on to GuideStar and to post something about your organization. You can post whatever you want, you can say whatever you want, and then you give them up to 5 stars. Here's what the page looks like. And this just happens to be one of our clients, Phil Abundance, which is a fabulous, fabulous organization. If you're not familiar with what they just did down in Chester with Fair and Square, go to the Inquirer and read about that. But they have one person who gave 3 out of 5 stars, one person gave 2 out of 5 stars, one person that gave 5 out of 5 stars. And if you click on each one, it says read more. Right here. If you click on read more, this is what comes up. So the point is not that you can read it from where you're sitting, but the point is just to be aware that there's text here. So this person who gave them 5 stars wrote in all this information, and then there's a series of 5 questions. Was your donation impactful? Well, how is a donor going to know if their donation was impactful or not? How likely is it you would recommend that a friend donate to this group? How likely are you to donate to this group again? When was your last experience with this nonprofit? A series of 5 questions that they encourage people to complete. And then lastly, was this review helpful? So this is a similar thing that you see with apps for your smartphone. People can rate apps and put in reviews, or on Amazon.com, people can submit book reviews. Well, you can now do it about organizations. Now, the last time I gave this presentation, we did this presentation last week in Washington, someone asked a question which I haven't found the answer out to yet, but I will. And the question was, do you have an opportunity to vet the answer? And if you don't like what somebody posted, to have it not show up? Does anybody know the answer to that? I suspect the answer is you probably can't do much about that, because if you could have done something about it, if it were me, I'd go in there and I'd get rid of those 2 stars there. I wouldn't want to show that one. I know on my blog, if somebody writes a comment, I get an automatic email on the blog, and I have an opportunity to either accept the comment or to reject it. I don't have a chance to edit it, but if I don't like what somebody wrote, I can just click reject and it doesn't show up on the blog. You don't seem to have that ability with GuideStar. So let's take a look at where we are today. So our topic today, we've now talked about how did the situation develop. We did the brief history. We talked about who some of the primary charity watchdogs are. And we talked about how at least 3 of them, what they're looking at and how they were rating you. All right, this takes us to the next topic, the overhead myth letter and the limit of financial ratios. How many of you are familiar with the letter, the overhead myth letter? Okay, so maybe a third of you. So if you haven't heard about this, Google it, find the letter. It was released on Monday, June 17th. 3 nonprofit organizations released a letter that they titled The Overhead Myth. The 3 organizations were Charity Navigator, BBBY's Giving Alliance, and GuideStar. This is a fascinating letter. I just happen to have a copy here. For those of you with good eyesight, there's the letter. For those of you who can't read that, I'm just going to read a few selected blurbs. It starts out, to the donors of America. Okay, so far so good. We write to correct a misconception about what matters when deciding which charity to support. The percent of charity expenses that go to administrative and fundraising costs, commonly referred to as overhead, is a poor measure of a charity's performance. The letter says it's a poor measure of a charity's performance. We ask you to pay attention to other factors of nonprofit performance. In fact, the letter goes on to say, many charities should spend more on overhead. Overhead costs include important investments charities make to improve their work, investments in training, planning, evaluation, internal systems, as well as efforts to raise money so that they can operate their programs. These allow charities to sustain themselves. You should be spending more money in many cases on these things, not less. And in fact, there was a very influential article that appeared in the Stanford Social Innovation Review called The Nonprofit Starvation Cycle. And they quote that from that article actually in their letter. Fascinating. You've got organizations that release a public letter that are saying, what we are doing is wrong. What we are doing, the information that we're putting out to the public, it's a poor measure to try to determine how well a charity is performing. But nevertheless, since that letter came out, they're still doing it. I look at these websites all the time. I don't see anything that's changed on any of the websites in any substantive matter. They are still doing the same stuff, despite saying that it's a poor measure. They actually set up another website called theoverheadmyth.com. Overheadmyth.com. It's actually run by GuideStar. And they're encouraging people to sign on to this and to sign into their petition. I don't know what impact that has to sign into the petition, but there's quite a few people who have done it. And here's what they say, here's what GuideStar says on this website. And they repeat, the experts have spoken, the percent of charity expenses that goes to administrative costs, commonly referred to as overhead, is a poor measure of a charity's performance. In a historic move, the leaders of the country's 3 leading sources of information on nonprofits denounce the overhead ratio as a valid indicator of nonprofit performance. So we're left in sort of an awkward position being in the nonprofit sector. They're denouncing what they do as being a poor measure, but yet they continue to do it anyway. They're continuing to rate us based upon these poor measures. So we have to try to do what we can to put ourselves in the best possible light without shooting ourselves in the foot and without hurting the infrastructure of our organizations. So here are some quotes that I've already read from the website. There's one other, I don't have a slide for this. This is reprinted by something called the Nonprofit Watchman. It's a CPA firm. I think they're located in Orlando. They have offices in Orlando and Atlanta. This is from their blog, nonprofitcpa.com. They say, the measurement of overhead expense is inherently subjective and can vary dramatically based as much or more on the accounting methods an organization uses as its actual efficiency. Many non-accountants incorrectly assume that such measurements are elements of precision. I'm an accountant, I try to be precise, but nevertheless, they don't realize that in many cases, the differences between overhead ratios of 2 very similar organizations may be more a function of their accounting methods than of the substance of their operations. There are elements about how we allocate our costs which are highly subjective, such as how do we allocate the executive director's time between program, fundraising, and administrative, just to pick one of dozens of examples that we can possibly give. So, this slide was just meant to say that ratings are nothing new. We have ratings in all walks of life. It's not as if nonprofits are the only organizations that are being rated. Okay, so getting back to the problems now. There are a number of problems. The first problem is that the measurement of overhead expense is inherently subjective. Here are the instructions from the IRS. If you've never read this, I bet most people here have not. Here's what the IRS says in their instructions. And I'm just going to read you 2 sentences from this. Use the organization's normal accounting method to complete this section. If the organization's accounting system does not allocate expenses, the organization can use any reasonable method of allocation. Any reasonable method of allocation. This is the IRS. Now, there are some lines where they do give additional guidance, but the general instruction is use any reasonable method of allocation. What that basically says, and what that basically means is that, and we see this all the time with our clients, especially when they change audit firms. One audit firm, we won't get into a discussion about who should be preparing the schedule of functional expenses. The client should be preparing this, but the auditors will usually prepare the 990. But we'll see that if one audit firm leaves and another audit firm comes in the next year, they'll come up with totally different calculations of these numbers. And it's not because one is doing anything wrong, and it's not because one or the other is trying to be devious. It's just that what one deems to be reasonable, another firm something else can be deemed to be reasonable. There is a lot of these calculations are inherently subjective. Most people don't realize that. The accounting rules really say that they want whatever you do to be reasonable and consistently applied. So if you read FASB 117, which talks about this, reasonable and consistent. Last year you charged 50% of the executive director to program. This year, maybe you charge 50% of the executive director to program. It's consistent. And if you have some reasonable or plausible way of coming up with that calculation, most times it'll be accepted. Maybe you have timesheets, maybe you don't have timesheets, whatever. As long as you can have some reasonable explanation and you do it consistently. So, first 2 problems with this is that the information is very subjective. All right, even if you throw out this, suppose you're sitting there saying, no, Eric, I don't believe you that it's really subjective. Well, we still have the problem, and that is, how well does this show how effective your organization is in meeting its nonprofit mission? Now, I'm assuming that you all are aware of the arguments. Your overhead is low, according to your calculations, but maybe you're just doing a poor job of fulfilling the mission of the organization. Maybe the organization down the street that has higher overhead, according to their calculations, maybe they're just doing a fantastic job meeting their mission. You can't tell that just by looking at the ratios. Here's another problem. Even where there is specific guidance on a particular line, there's a high rate of error because people who are completing this, they don't know the rules. So even when there is guidance as to how to allocate costs between those 3 columns, it's being done wrong. Even when they know the rules, there's differences of opinion among accountants. We talked about the allocation of indirect costs earlier, and we talked about joint costs, those 2 factors where Charity Navigator will come in and make an adjustment. And of course, last but not least, there's pressure on nonprofits by funders and other organizations to try to show a higher program expense ratio and a lower overhead expense ratio. So there could be some bias. Let's not beat around the bush here. There is bias, and organizations are going to try to move information over. Basically, what I'm painting is a picture where this information is so subjective and so, I won't use the word worthless because there is value to it, but there's very little value to it. And in fact, there was a hearing in Congress not too long ago, in late 2012, where they brought in an expert on the 990, and this was the House Ways and Means Committee on July 25th, 2012, when the expert said that the Form 990, the information is ill-documented, unbelievably subjective, and all too often geared to a desire to appease to donors or meet aspirational criteria employed by charity watchdogs. This expert recommended that the IRS discontinue requesting this information. Fat chance of that happening anytime soon. All right. So charity watchdogs are feeling the heat. That's why they came out with that letter. So where are we? We're right on schedule here. This brings us to what can you do to put your organization in the best possible light? Without doing anything wrong, without fudging numbers. That's a technical term, by the way, fudging numbers. So no one's advocating that. No one's advocating doing something that's inappropriate. We don't let our clients do that kind of stuff either. So we're not. That's not what we're talking about. But we're talking about real things that you can do. All right. Well, step number one is know what the charity watchdogs are watching. So I've given you an introduction, but read their websites. As they say, the devil's in the details. If we had more time and with a smaller group, and we could actually go through the calculations, or we could pick an organization's numbers and we can crunch the numbers for them to see where they would have rated had they been rated, so that you can be proactive and take steps now, so that if next year or 5 years or 10 years from now, as Charity Navigator grows and they rate more and more organizations, one day they might be rating you. Well, be proactive today about what may happen down the road. But you first have to know what they're looking at. All right. Next, understand the problems and limitations behind their methodology. So it's pretty obvious to you all my feelings on that subject. Additional steps that you can take. Right? Find out if your organization is being rated. Go onto their websites, look up your organizations, see if you're being rated. If your rating is not as high as you would like, find out why. Understand how the watchdogs are determining their ratings. All right, now understand the gap in IRS rules. Now, no one suggests, you're all busy with your organizations. You've got an organization to run. You've got a mission to accomplish. If you need help understanding what the GAAP rules are, GAAP is generally accepted accounting principles. If you need to know what the accounting principles are, IRS, you can ask us, ask your auditors. There's a number of excellent auditors in the room. I recommend all of them. That's why we invited them to come. Grab them before they walk out of the room and talk to them. Or talk to us, because we know these rules also. Consult with a knowledgeable accountant or CPA. If the rating agencies are asking you for information, give it to them. I mean, why not give it to them? We're public charities. We're supposed to be transparent. They're not, in my view, they're not asking for anything that's unreasonable. If you think the rating agency made a mistake, talk to them. Call them. Look, the folks at the rating agencies mean well. They're all trying to do something good for the sector. And if you talk to them, and I've heard a few of them speak, they are very passionate about what they do. They're not bad people. So if you disagree with something that they're doing, talk to them, and hopefully they'll be receptive and they'll listen. All right, more things to do. If your board needs to enact various things so that on Section 6 of the nonprofit, that's the governance section, you can check more yeses Do you have a whistleblower policy? Do you have a document retention policy, conflict of interest policy? Get your board involved. Now, beware of one thing. These policies are not something to be taken lightly. You don't just sit down and in one meeting enact one of these policies. These actually require some thought. With a whistleblower policy, what if your policy says report to your superior, but your superior is the person who's the problem? Well, now who are you supposed to report to? All right, well, maybe the policy says report to the board. Okay, well, if you go to the board member, what does the policy say the board member is supposed to do? These things are not trivial. The same thing with document retention. I was on the board of the Philadelphia Foundation for 9 years. Coming up with a document retention policy for a foundation that has 120 plus years of a history is not a simple matter to figure out how to retain things, and some things are paper, some things are electronic. This takes some discussion, but it's a good thing to do anyway. Your organization should have a document retention policy, and I think a whistleblower policy is a positive thing to have, and so on. Conflict of interest policy, definitely that's a good thing to have. So if you don't have those things, motivate your boards, and if you are on a board, make sure you have those things. Post your audit 990 on your website. This is low-hanging fruit, folks. If you have an audit, you definitely have a 990, post them. List your key staff and board members. They're already on the 990. You might as well put them on the website as well. Now, on the website, of course, you don't put salary information on the website. And you don't have to put email addresses on the website either. Now, some organizations do have a valid concern with privacy of information. We work with some organizations, for example, that worked with, I'm going to say battered women, but also that work in child abuse issues and substance abuse issues, and privacy is such an issue that they can't even put their address of their office on the website. So certainly there are valid reasons why you need to keep certain information, certain sensitive information private. So if you have that situation, yes, keep the information private. But if you're among other organizations where that's not an issue, post that information. Talk to your auditors. We teach our staff actually that auditors are our friends. And so your auditor, believe it or not, I shouldn't say that, I'm being a little facetious there, but your auditors are all bright people. They're all passionate about what they do. They know what they're talking about. Engage your organizations in a conversation about what these rules are and about cost allocation approaches. Your auditors will appreciate the fact that you're asking, and I think you'll find, at least from the auditors represented in this room, they'll all be very helpful to you in helping to explain these rules to you. So right on schedule, I have 9:59. We're scheduled to go to 10 o'clock. So this is what we covered. Not everything that can be counted counts, and not everything that counts can be counted. I love that quote. You can find more information about us on our website, yptc.com. And I'm going to stay. We have this room, I think, at least until 11 or later. I plan to stay. We've got at least a dozen or more members of our staff here. If any of you have any questions about anything, we won't leave until the last person here leaves. So thank you all very much for coming. I hope this was helpful.